Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a different topic from the investment landscape and consider how we can apply the teachings of the father of the craft, Benjamin Graham, to the problem at hand. In this episode, we should be considering the current stock price of a certain little technology startup that goes by the name of Tesla. I'll point out right at the outset that clearly this is not going to be a study into value and whether or not Tesla stock can be purchased on value grounds. It clearly can't be, but that's not to say it is nonetheless an interesting case to investigate, and it should, if nothing else, highlight some important lessons into the insanity of man. So without further ado, let's get right down to it. As ever, sit back, buckle up, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. Of course, my reference to Tesla in the introduction as a small technology startup was meant to be tongue-in-cheek, my attempt at humour, but nonetheless, joking aside, Tesla can still very much be considered a startup company of sorts, given that the business is little more than 20 years old. It's true to say that I have jackets older than that. It has grown rapidly in those intervening 20 years, however, and its share prices continue to confound the likes of me, who has been continuously droning on for years that it's way too expensive and that it's going to tank any time soon. The issue for me with the share price is not that Tesla isn't a brilliant business, making fantastic products. It is that it has been priced on the basis and the assumption that it is going to have the whole automobile business to itself. There was a time, perhaps only a few years ago, when this proposal of such a dominant market position would have seemed a somewhat far-fetched but a far from impossible outcome. If you were of the belief that electric vehicles would, in the future, become the main means of personal transportation, usurping their fossil-fueled brethren, then it perhaps would have only taken a small leap of faith to conclude that Tesla could become the only automotive show in town. This was such an obvious conclusion to be drawn at the time because Tesla pretty much was the only show in town when it came to EVs. Tesla vehicles were head and shoulders, knees and toes above anything else on offer in the market. If you wanted an electric vehicle with a range that made it a suitable replacement for your gas guzzler, then the only decision was which Tesla model to choose. It helped naturally that Teslas are great to drive and supercar botheringly quick, in a straight line at least. It also helped that they were highly desirable and something of a status symbol. But much has changed in the intervening years. Finally and somewhat reluctantly, the heritage manufacturers, almost from a standing start, have begun to make electric vehicles that are, for the most part, as good as Teslas. In a few cases, I'm thinking of the offerings from Audi and Porsche, both from the VW stable, have produced EVs that have arguably even bettered Tesla's products. But what has really come as a surprise is the rise of the Chinese brands, who have begun to produce some really good Tesla alternatives. BYD, or Build Your Dreams in particular, are now producing cars that are objectively not far off Tesla in terms of quality, driver dynamics and range. And as you'd expect from a Chinese manufacturer, these are available at knockdown prices. What has become crystal clear and blindingly obvious is that Tesla, far from being the only show in town, will now increasingly become just a bit player in an overcrowded market. The virtual monopoly it had on the EV sector is now nothing except a distant memory. There is nothing really unexpected about this. If demand exists for a product, there will always be plenty of businesses who will look to fill that demand with competing products. There's only one thing that is really surprising, and that is that Tesla's stock price has not altered to reflect this newfound reality. Tesla is still priced very much on the basis that it's still the dominant player, not the bit player it has increasingly become. Investors in Tesla will be keen to point out that the basis of their investment is no longer about the EVs themselves. Rather, it is about the technology behind those EVs. I'm talking of the autonomous driving and the revenue streams from its data handling capabilities, and of course separately the undoubted brilliance of one man. In other words, now they've given up speculating that Tesla EVs are going to dominate their sector like they once did. They've invented another reason why the business is worth paying any sum of money for. It might very well be true that Tesla will go on to make a killing out of autonomous driving technologies, but this is to assume a couple of very important things. Firstly, that autonomous driving is the future, and I'd personally say that they're onto something with this, but they also assume that the lead in this technology will be long and enduring. And just as Tesla investors bet the bank that their lead in electric vehicles would be just this, I fail to see how other businesses will not, in a relatively short space of time, catch up and perhaps even exceed Tesla's autonomous offering. Let's not beat around the bush here. The valuation of Tesla stock is absurd on any reasonable grounds. The average price-to-earnings ratio for the stock over the last 5 years has been around 225 times, and at the time of writing, the figure stands at around 160 times. This is compared to around 28 times for the S&P index as a whole, and around 18 times for the FTSE All-Share Index. As a quick reminder, the price-to-earnings ratio is the metric that compares a business's stock price to its earnings per share, essentially telling us how much investors are willing to pay for each dollar of profit a business generates. Some consider this to be a useful tool in uncovering undervalued stocks. As an aside, I do too, but I do feel it can be a rather lazy and misleading metric. But that's for another episode. But we needn't argue too much about the merits or otherwise of the PE ratio as a means to measure value. Tesla stock is massively overpriced on any metric you happen to choose. It is not priced on the basis of today's reality, but is a de facto bet on the future turning out precisely as its investors foresee or hope. It is a speculation in its purest form. There is one thing that I always like to make clear about speculation and speculators, as it can sometimes feel that we as value investors scoff at the rank stupidity of it all. But without speculation, where would we be exactly? Somebody had to take a punt on Tesla in the first place. One of those people was, of course, Elon Musk. It was a bet, a speculation that, as it turned out, worked out pretty well. But for every Tesla, there will be a Fisker or a Nikola that did a lot less well. Speculation rarely turns out well for those taking part in it. But when it does, it can pay out really big. And for that reason, there will always be a long line of speculators more than willing to bet everything on untold riches. So we should not demonise the speculator. Rather, we should be thankful that there is someone else willing to make these risky bets, because without them, we'd be spending the first half hour of every morning before work just tacking up the horse. Tesla's share price keeps proving me wrong, and I suspect it will continue to prove me wrong long into the future. But really, whether Tesla's current investors profit or not in the long term should be immaterial to the value investor's outlook. If someone places a $100 each way bet on a horse that comes in first and wins big, we don't ascribe that outcome to investment smarts. We say they were lucky. And if in 10 or 20 years' time, holders of Tesla stock are still doing well, then we can say about them pretty much the same thing. I certainly don't believe that the mysterious charms of Tesla stock and Elon Musk will fade away from the mindset of investors anytime soon. But once again, I feel they've fallen into the trap of believing that no price is too much to pay for a great business. What I do promise to you, my listeners, is that if ever my opinion does change on the merits of buying Tesla stock at these sky-high valuations, then I'll promise I'll give you a special signal. And that signal will be me being involuntarily committed to a psychiatric hospital. So do watch out for that one. Honestly, folks, go to the racetrack. You'll have much more fun. On that, I will draw today's podcast to a close. I do hope you've enjoyed it, and what we've talked about today regarding Tesla stock gives a good distinction between the act of investment and speculation. If you've enjoyed it, do consider adding to playlist. That way you'll be alerted as soon as any new episodes land on your platform. And also please do continue to spread the word. We do have some exciting new developments in relation to the podcast coming up in the months ahead that I hope will make it a more engaging place to be. And I hope to give you, the listeners, the opportunity to become more actively involved with the podcast and its community. So do look out for some announcements on that in the not too distant future. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.